The S&P 500 makes another all-time high. Smart money, dumb money is giving a flashing signal. How is France interfering with the US economy? CPI came in lower than expected. We'll show how you can see it in the charts. NVDA's massive run, and is it done? The volatility skew and how it's affecting your daily trading. NASDAQ continues to take out all-time highs, what the MACD histogram is telling us and how to read it correctly. RSI and how to use it intraday for trading opportunities. Is the smart trading index better than smart money, dumb money confidence spread right now? We'll explain what to look for. The NASDAQ continues to lead. We have a ton to go over. Let's get to it. Hey everybody, welcome back. Today's video is packed. Smart money, dumb money specifically is going to be pretty big to cover. I want to walk through a trade. There's 5 ideas I need to go over with you as well. We need to take a look at what's going on under the hood, but we're going to dive into a lot of this. We're going to dive into the skew, a lot of areas, a lot of things are going to be covered today. Let's just jump right into it. There's parts of this video you're probably going to want to watch a couple times. A lot of it's unedited, but it's just packed. Let's go. So we're just going to start with the basics. ES, and just look at what's going on here. And we can see it very clearly. This was an area of contention, and all of a sudden we're breaking out and we're pushing. Now, I think there's a couple reasons why we're becoming so appealing, that the US is becoming appealing, and we're going to address that. But if we take a look at the NASDAQ as well, we can say whatever we want about CPI, we can say whatever we want about the Fed, we can say whatever we think about interest rates. This is what happened. You made a higher high and then you broke out. And what we're doing right now is just looking at the most basic of charts and just making a really clear decision on whether or not we're going to say that this is going to stop because we just think it's going to stop, or if we have a reason we think it's going to stop. And I think that's where your head needs to be right now. If I look at this bar on the weekly, I don't see any reason to just suggest that we're just going to miraculously stop. I'm not that smart to call the high. Most people are not. This is what we have. This is what we have to understand. And now we have to start looking at why this is going to happen. Now, if you've been watching these videos for some time, you're aware of the equity risk premium. If not, I'll go over it again probably next week. Make sure you subscribe to the channel because we're going to cover a lot of topics today. But for time's sake, I'm going to work some of them in next week because there are some nuances here with equity risk premium that we have to pay attention to. But if you look at the bond market, this is not rocket science. You closed at a 421. And I think that's really important. I do. Now, we have closed below the 55 on the weekly before, and we did it back here in December. And once we did that, it led to the single greatest move you had all year. Are we going to say that that's not going to happen again? Or are there differentiating circumstances now? Yes and no. We're going to get into some of that. But you really need to watch this. I think this is one of the most telling of the original graphs right now I'm about to show you. If you look at the dollar is telling you a different story, and the dollar is rallying. Usually the dollar does not rally when you start to see the 10-year do this. You see the opposite. But again, I think there's a reason for that. If you look at copper, this is one of the most fascinating charts that I saw out there, and I wanted to just bring it to everybody's attention. We don't have enough copper, but did copper get ahead of itself? A lot of people would look at this area and go, this is where we rejected last time. That is a complete rejection. There are a couple things about copper that we should be paying attention to. Copper usually only rallies. People will say, oh, Dr. Copper, and it only rallies when the S&P rallies. Does that look like what happened? S&P continued to push higher, and 3 weeks of just puking copper, right? Now, what's important about this is the puking may stop. And if it does, then that could add another catalyst by looking at commodities. But up, down 1, 2, 3, and then now you're getting your little green bar here. It's a pretty ugly green bar. You can't even close 50% up on it, but it's definitely a green bar, and it's certainly what we want to pay attention to. Another sector that we really need to just don't throw it away, pay attention to it. The stocks, it's actually spreading out. I know people are like, oh, I missed it. The only thing that you've missed is the fact that you're not doing anything about what's happening. Doesn't mean you have to get in right now, but if you're not playing these names, that you're not understanding what happened with Apple, you're not understanding what's going on with AI, and I would do some due diligence. They are topics we're going to cover in great detail in future videos, and we've covered in great detail in the back end too. But there's a reason this is broadening out. There's a reason this is getting stronger, not weaker. The 2 wild cards out there that we have to really pay attention to and look at what are investors doing based upon these wild cards. First wild card out there right now for me is France. It just seems like once Macron went out there and did what he did, but by calling the Snapple action, we just completely plummeted on the exchange. Now, if we take a look at this and just mark from the close on the week to where you're at, it's a 9.5% drop. That's not a small drop. Then there's a lot of what ifs out there that would get people to come out of the market, but it doesn't seem like they are. And then we see what's going on in Mexico with their election. And you can see how we have this major trend that's been going on for multiple years and how we're cracking it. What are institutions doing about this and how are they positioning themselves? Let's take a look at smart money, dumb money. One of the indicators we look at a lot is smart money versus dumb money. And this is the difference really between institutions and retail. So we don't really refer to it as smart money, dumb money. We refer to it more as what are institutions doing and what are retail doing. And the reason for that is if you look right here in red and we look here in blue, smart money is defined as blue, dumb money is in red. You'll note that dumb money tends to catch the move when it gets going, and smart money tends to sell into that move. So smart money tends to miss the meat of the move. Therefore, we don't really refer to it that way because when the trend's your friend, we really want to follow, quote, dumb money and just trade what's actually happening. The inflections are important for us, obviously, and so are the spreads between these two because they mark and denote really key levels where we want to do something. The problem with indicators is that when somebody starts realizing that everybody's looking at an indicator, that indicator can change. Or if institutions feel that they're being watched a little too closely, they'll change their behavior. They can only change so many things though. Now what I'm going to do is show you something that I think is a better picture than what's going on with smart money, dumb money, because I'm getting the sense that they're starting to hide a little bit in here. Now we've started to notice this change in January right down here. And we started to see this spread, and all of a sudden we didn't really have much. And what's interesting about this whole area from here over, if you look, the range was pretty much the same. No matter what happened, it was the same range. Well, why is that? So smart money, dumb money is calculated specifically by different vehicles, different asset classes, smaller asset investments. So if you're doing odd lots on the futures market or smaller lots, it goes into dumb money, not smart money. So if someone understands this, they could actually break it up and start quantifying as dumb money versus smart money and vice versa. They could do that. They could hide what they're doing. And we know for a fact that institutions hide what they're doing. You can see the volume change at the end of the day, and now it's getting down to the last 10 minutes of the day. But what's important about this is for us to understand how this is calculated and then how we can use this to our advantage. So when we see these spreads and we see their movement, what we're always looking for is dumb money buying? Because if dumb money is buying, chances are that this is going to increase, right? You can just see that pretty clearly. What we're always looking for are those inflections. But usually these inflections, when they break down like this, lead to some kind of movement down. For example, if you look right here, you'll see that did nothing. Whereas this one marked the top. This one marked the top, and so forth and so forth. And then all of a sudden it got really weird, didn't it? It just stopped working. And I think this is worth mentioning because when we dive into this, you're going to go, oh, that actually makes sense. But it's not just here. I mean, you could actually go back to 21, 22, and you could see once dumb money stops, that's the end of the move. And then the spread changes, and we're going to get into the spread in a minute. But just remember this as we go forward. Remember, you can always rewind back and watch that again. There are parts of this you might want to watch 2 or 3 times just to get the concept. Again, this is not something that I did, but this is by Sediment Trader down here. They do a really good job with this indicator, and I've talked to them before about being able to share it, and they're fine with it. So if you look right here, the 1 year we're back to smart money, dumb money, we refer to it as institutions and retail. And again, we're just going to look at what's happening. Okay, what's happening here? And we can see from that point on, we go higher, okay? And there it marks, right? X marks the spot, and you could see all we did was lift. At the same time, what did smart money do? As we went higher. So therefore, you would not refer to them as what? Smart money. You would refer to dumb money as smart money because they actually outperformed when institutions were selling. When things get, quote, cheap, that's when smart money will buy. But smart money uses different characteristics to determine, quote, cheap. They'll use equity risk premium as we've gone over in the past. But let's just keep moving forward. What do we see happening here? We see smart money buying. Now, when they buy, what we're expecting them to do what? Well, when they buy, we're expecting that to mark a top. It's not. Why is that not marking a top? Okay, so then you come here and you look and go, okay, well, we bought, and then all of a sudden what happened here? We sold. It's not marking a top. See the difference? All we're doing is this. You have a little nuance here, but that's it. So we're widening and we're narrowing, and at the same time, we're just going higher. So inevitably, you're going to look at that and go, oh, well, we're going to roll over. I mean, even here from January on, when you dipped, you can still argue that you made a level before this kicked back up and started buying again, right? You can see that right in here. And at the whole time, you had pretty natural buying in institutions. Again, when you know what this is and you know how it's calculated, you can use it differently, and we're going to get to it. Now, nothing could be clearer than just using year to date. And you can see the cross right here. You can see the lift, and then you could see the drop, and then you could see that we just lift. And then you could see the drop, which is supposed to lead to this, but at the same time, when they're buying, that's supposed to mark a top, as it did here, right? And then what happens? You get this, but you're not getting that now. And there's a differentiation. Let's get to it. Now, what I think is helpful is they take smart money and they put it into dumb money, and then they divide it. That division is really important. Why? The division itself gives you a spread, and then you can utilize that spread. And in front of us is 3 years of the spread. So smart divided by dumb, you get the spread. Anything above is supposed to mark a level, like you can here. Change that color to something you can see. And you can see that right there, right? And so when you top out here at this level, on the spread, what's supposed to happen? When you top out and then you start pointing down, and then what's supposed to happen from there is that's supposed to mark a bottom, right? You're topping out, you're pointing down, it's supposed to mark a bottom. All right, yes and no. It does work. It doesn't work all the time. But if you look 3 years, you're going to notice that you have something really different going on. And for me, it's not what you think. Because if I come to September, and again, I think this is significant. If I come to September, October, November, what changed? Well, the Fed said they're going to stop raising rates. So if we just take a demarcation line from here, and it's really over a little further, but we're going to note that that's where we broke. And here we are. And then we're going to come to where we broke above in this area. And then we're going to just go straight up to here. You will note in this section exactly what happened. You didn't move anywhere. You didn't go anywhere. And at the same time, what happened? You had an entire movement from here over while the spread did not change. You don't really have that anywhere else. Even when you were down here, if you look at this area by context, you could argue, oh, well, you had something similar down here. Well, even if you take a look at that versus this area, you don't have anywhere near what happened here. It's not even close. So we're starting to see a shift. And then the question becomes, why are we seeing that shift? And then how do we profit from it? And I think the easiest way to profit from it, quite frankly, is to look at it and then go, okay, well, what's the change? Now, this is where it gets interesting. There's your change right here from smart money to dumb money. And all of a sudden, they're acting completely in tandem from all the way from November, mid-November, to April, as we just highlighted. Now, here it is year to date. And you can see from January all the way to April what transpired. What's important about this is if you go and take a look at what's happened since April in the market and you mark that level off, you'll see when we dropped. And then you can see the rally in the spread, the dump, and then you can see how we came back down from that level. And then what are we doing here? Why aren't we dumping? We're going to get to it. Now in front of you is the Smart Money Index. And this was a creation by someone, not through Sentiment Trader, but by another gentleman. Tools like this, you have to think about them in your toolbox. They have their place, okay? And you'll note that. For example, you'll note that if you were using this from the 22nd on, did you really see something that was of value? Not really, because it showed that the whole time that you were dropping at the same time this was going higher. So there was no value there. But when you start to see a trend, you want to follow that trend. And then we'd have to go, well, what is happening here? In order for us to understand what's happening here, you have to understand how this is calculated. The important thing that you should take away from this is you cannot use the same indicators all the time the same way. Just like when you're building a house. Sometimes you need an electrician, sometimes you need to hang drywall, right? Sometimes you need to frame the house. You need all these different components. And what's important about this is you don't throw the other thing away or the other tool. You just leave it there and you keep checking on it, making sure if you're going to need it or not, and you're making sure that it's ready when you do. But you want to build an arsenal of tools, and then you want to constantly be looking at them and try to figure out which one you're going to need for the job. Now, let me show you how this is calculated, because you'll understand why this is giving us an accurate reading and why smart money, dumb money is not really reflective, and it's not what you think. So you will hear me from time to time constantly talk about how investors, large investors, mask their volume and how they buy at the end of the day. This is not something that I learned or I created. The way that I was trained was back years ago through investment banks, right? So everything I learned was from high net worth and mid-markets and institutions. This was stuff that was taught to me, and that's how I learned the things that I'm sharing with you. The important part that I want you to get from this is a guy that was running money manager Don Hayes, pretty famous money manager. And what he did with this indicator is he came up with a way to look at things, really take out retail, and look at what the institutions are doing, what they're truly doing. Now, what smart money does and dumb money does is they use vehicles to determine what is smart, right, and what is dumb. What they're doing, or what Don's doing, is he's using time of day to determine it. So it doesn't matter what takes place when. What matters is when it takes place, not what. Okay? Huge distinction. So there's many variations. The emotional trading takes place in the beginning of the trading day. We know this. We know the first half hour of the day. First hour of the day is always really wonky. You're always seeing things like this. We're up, we're down. Everyone's having panic attacks. Everyone's high-fiving their bros, right? We all see that first half hour. I'm rich, I'm broke, I have a margin call, I can buy a yacht, where's my Lambo, et cetera, right? Until the end of the day, and then it just starts going like this. And then we're watching at the end when it explodes up, right? Got it? Good. Now, at the beginning of the trading day, as traders react to overnight news events, and economic releases, okay? While smart money takes the day to evaluate the price action. Have you ever noticed how much better your trades are after 12 o'clock, after everyone comes back from lunch? That your probability of your trades is always better in the afternoon, but the money that you always make, you usually make in the beginning of the day? There's a reason for that. High probability is towards the end of the day, and then you have low probability, higher risk, higher return in the beginning of the day. Just the way that it is. I'm sure you guys already saw that, but if not, now you know. Due to the assumed tendency that we want to bet against the opening action and bet with the closing action, you want to do what they're doing at the end of the day. There's actually even calculations out there to look at what's happening at the end of every Friday, just for point of reference. It's another indicator. Remember, these are all tools that we pull out at certain times. The way we calculate the index is to subtract the performance of the S&P 500 cash index for the first half hour of trading and add to the performance during the last hour. Okay, remember before I showed you an indicator that showed what was happening in the last hour. This was about a year ago. We went over that one. This is a little more refined and is very reflective of what the heck's going on out there right now. For example, let's say smart money index closed yesterday at 800 during the first half hour of today's trading. The S&P gained a total of 5 points. We then ignore what happened until the last hour of trading. Now suppose during that final hour we lose 8 points. To get today's smart money reading, we take yesterday's number, 800, subtract the opening gain or loss, 5 points, and add the last hour, minus 8 points. So that would get you minus 13. Again, what you're doing is subtract the performance during the first half hour. So no matter what, if you go up in the first half hour, they're actually subtracting it, right? They're subtracting it. That's how little they think about what retail's doing in the first half hour of the day. They take it out of their equation. All right. Unlike most indicators, there are no hard and fast rules to go by, but there are no absolutes we could point to and say bullish. Instead, we need to look at the action. When it's rising rapidly during decline, that means smart money is buying, and we should expect a bottom soon. Please listen to this. When it is rising rapidly during decline, that means smart money is buying. We should expect a bottom soon. What happens if you're at the top of a chart, right? Conversely, a rapidly falling SMI uptrend would tell us that smart money is selling into rising prices and expect a market decline. Now, if we are to look at this over 3 years versus looking at smart money, dumb money, which has been all over the place, and we were just to use the simplest of indicators and say, are you following this? Well, since November, the Fed, what has happened? It's a straight trajectory. If you used nothing else until it broke, okay, and to me this actually was a lagging indicator, it really was not a leading indicator, we'd have to have used something else. But if you're just following this up the entire time and looking at institutions are buying, they're buying at the end of the day, and then you have this little move right here. Now, why is this significant? Why I think this is significant is I'm going to put this right here. You're not even at the top of this yet and you're moving. And they're telling you that when you bottom or you form bottoms that you could be hitting highs. So what this is actually telling you in no uncertain terms, in my opinion, like look at the 3 hour or the 3 year right here versus here. This stuff gets absolutely glaring, somebody likes to say. And to me, I don't think it had as much value in here because I don't think we really cared just what they were doing. I think we cared what everybody was doing, especially how glum retail was, right? Different tools, different times. But now with the 3 year and looking at this, where do you see smaller time frames? It's like looking in the mirror. I mean, it's literally like looking at the same exact chart. You're calling the bottom right here, and then you're moving. The only thing that I would say about this, where do I see the deficiency in this? And I can show you how to plug in this deficiency with other metrics. But the only thing that we're seeing here with the deficiency are other tools in the toolbox. The only thing that we're seeing in the deficiency is the lagging of when it turns. But if you're looking at this from a truly trend perspective, if we're not following this right now, we're at a disadvantage. And what I really like about this is it showed you where they're like, yep, we're getting out. And then they're like, oh boy, we made a mistake. And look at what they're doing. They're getting back in. And the meanwhile, they're getting back in and they're behind. So that's probably why we're seeing a push in some of these names. Now, the reason I'm doing this is I got asked to follow up on Smart Money, Dumb Money in your comments. Even if I don't answer, I try to get to everybody. I do read all your comments. And I got asked a lot to do this, not only in the community, but also in the comments. But this is pretty obvious. And I appreciate your comments on it and what you think of this. I think this is something that we should monitor going forward. But you see the lag, okay? So what I want to do is I want to give everybody something that they can take out so they can see this lag ahead of time and start getting signs that, okay, maybe we do have an issue here. And we'll just remember these dates around May 20th and June for the next part of this. Now, one of the things that people do a lot is they watch these videos over again. So what made sense to me was to have someone help me. And so they've gone through that portion of the video and then they've outlined what they think are 8 key factors. I'm just going to highlight those and you can screenshot this if you want as well. But clearly they're pretty obvious what they are. But let's go over them for a quick second so that you could use this as kind of a cheat sheet. Smart money, dumb money institutions tend to sell into rallies like catching the move. In other words, you want to understand what they're doing. They're selling into the rallies. When you want to follow the trend, follow the dumb money, right? That's what you want to do. Understanding the spread between the dumb money and smart money is critical. For strategic trading, it really is critical. You want to know where they are, and then if there's a differentiation between those two, you want to take advantage of it. I can't be really any clearer about that. You saw that yourself, but it helps to have these little reminders. Indicators like smart money versus dumb money can shift behavior when they're watched widely. It's why looking at broader trends and inflections is important. You want to look at the inflections and you want to look at the broader trends, and you don't want to get caught up in the minutia. Institutions do master their trading actions by trading at specific times. When you start to understand that, you can take advantage of it. This is key. If I had to tell you out of the top 4 that we just read so far that this guy was kind enough to go through this and highlight, understand this. They mask what they're doing. Understanding what they're masking gives you a massive, massive edge. Using tools like Smart Money Index help navigate the market behavior behind simple retail and institutions. Because what you're doing is not only looking at the asset class, not only looking at what they're doing, but now you're looking at when they're doing, right? So now you're adding time. It's another layer. It's another tool in your toolbox. Do not rely on one indicator alone. Build a toolbox of strategies to adapt to change in dynamic markets. Smart money isn't always smart if you're not following the right trends, right? Understand what you're following. You might be following something and they might not be doing what you think they're doing. And then when you go back and look at the time, you might see something a little bit different. So you want to use the tools that you're supposed to use in the timing that you're supposed to use them. This takes time. Give yourself some grace, guys. Don't beat yourself up. I've been doing this over 2.5 decades at this point. It takes time to get this. Watching the spread between smart money and dumb money over time reveals shifts in market sentiment. This is true. You always want to watch where they cross. Where do smart money and dumb money cross? It's about spotting opportunities before they become mainstream. That's true. You want to be ahead of them. It was smart that this guy picked that up from that. I didn't know that I was that clear about it. That's good. The lag in smart money indicators can be a disadvantage. This is also true. Look for early signs and broader trends and stay ahead of market moves. I'm going to overlay something right now that will show you how you can do this yourself after you've looked at smart money, dumb money, to determine the validity of that move. Now, in front of us is the New York Stock Exchange Composite, and what you have below is the McClellan Summation Index. And the core thing about the McClellan Summation Index is that it is in my opinion, it's a leading indicator, but it's a long-term leading indicator. And essentially the way that it works is it works off the McClellan oscillator, and when these start to turn, they're just marking highs. When these cross, they're marking highs and lows. And the reason I bring this up is we were on the pre-market live stream that we do daily, and if you can attend them, I would recommend that they start around 8 a.m. Eastern Standard Time. But we take Q&A and then we discuss things and we talk about what's going on in the markets. Actually, a pretty good idea to attend or to listen to them if you can. But what got me was the gentleman said, "Hey, have you seen this? What do you think of this?" And this is really important because, yeah, this is an indicator. When this McClellan summation breaks that zero, yeah, you need to pay attention, because the breadth is telling you that you have an issue. The issue with this particular indicator and why I'm showing it is it's very similar to watching something along the sides of the smart money, dumb money. It's telling you a story, but it's not telling you the internals. It's not telling you the full picture. So the question then becomes, what are you going to use that's going to give you more nuanced? And I'm going to show you. Now in front of you is the MACD, moving average convergence divergence, and that is what's in red. And then in white is what they call the signal line. Now what I'm about to show you is actually going to measure the distance between these two lines. Now my statement there went on a couple assumptions. It went on the assumption that you understood what the MACD was, and it went on the assumption that you know how to utilize it or understand what it's telling you. And the important thing about that is if you don't, just go to investopedia.com. For this stage, what I'm trying to do with these videos, or what we are doing with these videos, is we're doing a beginning portion and a more advanced portion as well. As you could probably see that's where we're going. And this is getting a little more advanced, but anybody can do this, and I'm going to show you exactly how. You can see the date up here. This is the NASDAQ. Let's say you're looking at smart money, dumb money, and let's say that you think it's going to crack. Let's say you're looking at the McClellan summation and you know that's a long-term, meaning that is a long-term indicator. And I refer to those things as long-term, or it's going to take a long time for it to get there, right? Where you're looking for something daily, it's going to tell you that you're having a shift. Now that shift doesn't mean that it's always going to happen, but this is one way to determine it. There are others, but for time's sake, I'm going to show you this one. In front of you is the MACD histogram. So what this is measuring is the difference between the MACD and the signal line that I just showed you. And I don't really use the MACD, I'd rather use the signal line. And what you'll note by those crosses, because that's really where the action is, if the MACD and the signal line cross to the upside, it goes from red to green. And then it goes from green to red if it crosses to the downside. It's very simple. Now, what's important about this is the deeper it goes, the further this goes down. What we're looking for are changes in trend, because we have a long-term indicator and then we're looking for a short-term indicator to follow that. We have a long-term indicator such as smart money, dumb money, or the smart money index, or the McClellan summation. And now what we're looking for is a short-term trigger to tell us that, hey, it's on like Donkey Kong. Like, hey, now we have to watch what's going on here. Does this always work? No. What it's going to do is tell you, is it going to slow down? Is it not going to slow down? That's what it's good for. It's really good, in my opinion, for determining bottoms more than determining tops. But I'll show you how the easiest way to use this. If you were to look at the market, you will see a change in color. The change in color from dark green to light green, or dark red to light red, what this is telling you is very simple. Is this spread getting tighter? Meaning if the spread on the two between the MACD and the signal line is getting wider, you're going to keep getting dark green. If it gets closer together, which could be less bullish, then it's going to change colors. And then the degree of that also will start dropping, as you can see here. Now, the exact opposite is true with red. It will stay red until they start getting closer together, and then they cross here. What you are looking for are demarcation lines, and you're looking to make sure those demarcation lines last. Again, we're not saying it's a be-all end-all. I find this much better to mark bottoms than tops. There's other things to mark tops. But if we are to very simply click on that bar, and you'll see that, oh, okay. And then we change colors, and then you start looking at it daily, and you would just go, oh, okay, here's where we're at. And what happened? Well, we went sideways. All right, you're not falling out of bed, but you're not really going anywhere either, are you, for that period of time? And then what you would do is take a look at when the red changed to the light red, and you go here and you go boop. You drop that line right there. See what happened when it changed colors? And what happened? That was the bottom. And then what did it do? It lifted. And then when did it stop? It stopped when they started getting closer together. Did it stop exactly there? No, it went a little higher, didn't it? Right? And that's what you would refer to as what? A negative divergence. But they exist and they could go for some time. And this is the point that I'm getting at. You would say, well, if I went to buy here and I'm hoping that this happens, right, that you would just stay in it. Right. This is something that you're looking for. It's a nuanced portion that you're going to use as a short-term indicator over your long-term indicator. You're going to use this as a short-term indicator to overlay your long-term indicator. So if you have long-term indicators like this, for example, let's just say you're like, I don't like any of your malarkey, I just use moving averages. Do people still say malarkey? So, and you're like, I'm just going to use my moving averages. Okay, that's fine. You have a long-term indicator, a 12, a 22, a 55, which is what I use. You should use what you're comfortable with. But what this is going to tell us really clearly, right, is that we have a trend. Now, if we take our trend there and then we just drop this MACD, right here, well, let's not use that. Let's use the histogram again. And we're not going to wind up editing a lot of this because, frankly, I just don't have the time. And they are in order. There we go. Boom. So what we're seeing here is, oh, I'm going to overlay that. Now, maybe I was smart enough, to drop these in so that you can see them here. 12, 22, we'll pop that 55 in as well. And you're like, look, I'm above my 55, so I'm above my institutional level. I'm above the 22, so the bulls are in charge. And I'm above the 12, so I know I can swing trade, right? That's how I would use them. You can use them however you want. So then what I would do is then go, okay, but that might mean that I might just want to wait. So if I waited in here, did this provide a really good opportunity to buy off the 22? Yeah, it kind of did, didn't it? Did that 22 bounce coincide with when this was red, dark red to light red? Yes, it kind of did, didn't it? Okay, so you can see where we're going here. When these pull back to levels, key levels, and this is why I say I think it works better this way, so you can see there. Now, there are some, as some people like to say, that are absolutely glaring, as you can see right here. And what I would also say is you want to know what you're looking for. So if we see the color change here, what happened? We color changed and we still went up, and then you had this massive reversal and people would be shocked. You might not be shocked because you might say, hey, it's a little weak out there right now. You might want to be aware of that. And then it turns from red to green, and you would know that based upon that you have what? A strong market here. As people are saying, oh, I'm going to sell into here, you'd be like, my indicators are pretty strong. My long-term indicators are pretty strong, and my short-term indicator is firing and is giving no sign whatsoever, please listen to these words, no sign whatsoever of getting weaker. So instead of me telling the market what it's going to do, maybe use something like this. Now, while we're here, let's just take a look at what's going on. Let's clean off the SPY, and you can see that you don't have a color change there, and you can see how this clearly called the color change here, and you can also see, and we'll just mark it, did you call the top here? You're probably not going to call the top, right, because you're going to change and flip, but you did call a place of weakness, and it did drop down, and then based upon that, you could see that weakness and how it kind of called the top, didn't it? It doesn't always do that. You got ran over like a train here, look, okay? And again, this is why we always talk about the stool, right? This is why, because it's not a be-all, end-all, but it's one thing, and then you flip down here and you had your longer-term trend, so you might have been concerned here, but then when you flipped back, you knew it was on. All of this is connected, but if you take your long-term indicators and you utilize something like this with a short-term indicator, it will make your life very easy. And what we're fighting for here, guys, is we're fighting for inches. You're constantly fighting for inches, and you're constantly fighting to make the probability of your trades better. Now, I want to show a trade, but I want to preface it with a couple things, because this is a trade that you can start learning to do yourself, and I think it's extremely helpful, especially to those that are doing short-term trading. Again, if you have been watching these videos for some time, you know that I do a lot of day trading. Probably 25-35% of what I do is day trading, then probably 20-30% is swing, and then long, and then alternate investments like 5 to 10% would be M&A activity or options, that kind of stuff. But most people think that all I do is day trading. It's not accurate. Matter of fact, when you watch the video and you watch the trade live, you'll actually hear me add to this position another account, which is why I want to cover this. The account you're seeing is an aggressive trading account. This account is the same exact account that I used in 23 in the US Investing Championship. It's also the account that's currently in there, and let's rock and roll with this. But let's get to a couple points that I want to get to here. I get asked what I started with this all the time. This year it started with like $1.60 or $1.70, something like that. And where are we at now that I think is important is this win rate. Because this is not great, this win-loss. It should actually be greater. It should be more like a 2-to-1, right? I'd like to be around that 2-to-1 area. The profit factor is 188. I think that should be higher. The thing that I think people need to take from this more than anything is the win rate. And I've been commenting on this for some time, and I'm going to comment on it. I really think it's important for people to understand that you're not going to be at 80%. And the reason that's important is because you have to honor your stops, right? If only half your trades are going to work, you have to honor your stop. You have to be in your losses for the least amount of time possible and in your winners for the most amount of time possible. That just makes sense, right? Why that's important is I watch so much stuff out there where it's like, oh, I'm at 80%, I'm at 90%. No, you're not. You're really not. You might do it for a month. You might do it for a week. We've all had runs like that where everything we touch, right? But you're not going to do it for years and years and years. It's just not feasible, no matter what anybody says. If you look at the biggest traders in the world, the legitimate biggest traders in the world, the guys that Steve Cohen, guys that own the Mets, Paul Tudor Jones, guys that are just legends, Simons, those guys are 51, 52, 53%. Steve Cohen's best trader is 62%, makes 9 figures a year. So when you start to hear these guys saying, oh, I'm at X, I'm at 80%, no, you're not. You're just not. And anyone that actually trades knows that you're not, because if you were able to do that, you could legitimately print money. What you need to do is you need to get this to a point where you're getting over the coin toss. That's your goal. As much over the coin toss as you possibly can. Think about it that way. And then you want as much edge in the coin toss in your favor And if your coin toss goes in your favor, wouldn't you want to press that bet more and more and more? That's what you're doing. And when the bet's not going in your favor, wouldn't you want to press it the other way? That's the important thing about win rate. That's all you need to take away from it. Now, the trade expectancy here is important for what I'm about to show you, and this is important as well. But what I want to do is I want to get into, click off this button for a second. I want to get into the month and remember these numbers, you can always go back, but watch when we go into, let's do 30 days, which would take us to what, the 15th to here. All right. And you're going to see a couple things that have changed drastically, right? And what's changed here more than anything? Button. Look at the trade expectancy, look at my profit factor, and look at the win-loss rate. Now, this is a skew. There's a couple of them. This actually took over a couple days. And I think that one of the reasons it's there is just maybe what happened with Schwab and the transfer of this account. I'm not sure. But nevertheless, it all didn't happen one day. But what's happening here is you're getting way more volatility, and you're seeing that. You're getting this level of volatility, which is like, this is my wheelhouse. This is my kind of market. Now, you know for a fact that you would look at it and go, well, why doesn't everybody own tech stocks? Well, you don't own tech stocks with all your money because they do this and then they do this. People haven't seen this for a decade. They're not used to it. There's a couple of reasons for it, but the skew has changed. We went over this about 2-3 weeks ago in a video on the skew, the piece put up by Nomura, and the fact that you're going to see way more volatility, but the VIX isn't going to move and people aren't going to know why. And that's important because this provides huge opportunity, but you have to know what tool to use in your toolbox to do this. So I want to walk you through a very simple trade that we did in the community and one that you can do yourself. Again, I just want to preface this. This is one account that I trade. It is not all the accounts that I trade, and it's also what I consider, with the day trading and everything, a pretty darn aggressive account in the way that it's managed. Let me show you this one trade and then we'll dig into the pieces of it. Now, this trade was done on Monday, June 10th. And it's interesting now because you were trading 100 shares. Now you're trading 1,000 of NVDA for the same movement. But I want to show it live, but I just want you to get a couple things. So this is really where we're getting involved down here. And you can see the timestamp here, and you'll actually hear the timestamp live. And I think it's important to see these trades play out live, and that's why I actually do the live trading in the community. I think it's a big deal because you don't know what's going to happen, right? You think you know what's going to happen, but you don't know. And then it's obvious after the fact to put in a chart and go, oh, well, this is where you sell. You have to see it in the throes of the actual trade. But if you look at that 9:30, you get the reversal. It comes back down. I'll get into in a moment here how we showed this when I show it live, and then we'll go from there. And then what I'm doing, as always, is I trim into strength and key areas. Right in here was VWAP, and I'll show you that in a second. And I'm selling into that when people are trying to buy that flip. And then you came back to where your break even was, meaning where you opened on the day, scaled out there, and then I just held a runner right here, and that's where we got out of the runner, or where I got out of the runner. But let's watch it live. You're at support for NVIDIA. That's not great. You gotta see if you hold that support. You're probably gonna go right through it. Looks like just letting it go. I'll find a spot to add to it later. NVIDIA is giving me no indication to buy yet, zero. If you took Saturday's class and you know what a control bar is, you might be getting a little giddy. Oh wow, I can buy thousands now. This is fun. Hold on, buy more over here too. More for everybody. I bought NVIDIA if you just off that move. If it takes out that low, it cost me $1. If you did that for the day trade, you got to be pulling money out, guys, especially as you get up to here, right? You're going to just have to start getting in that habit of, pulling money out and going from there. Up here, it was up like about $1. I really haven't done anything with it yet. Maybe if it makes a doji and it breaks the doji, I'll kick half. NVIDIA held. There's so many things lined up for that trade. It's silly, right? By the time everyone's waiting for it to flip VWAP and everything, we'll be selling it to them. NVIDIA looks like you're going to break VWAP. You can see why those control bars are important. Right into this, I'm going to sell some. So if you just did it for the day trade, you got to get out. You have to trim. I shouldn't say get out, but you want to trim like when you can, right? And there goes NVIDIA over VWAP. Up 2 on the day trade, I'm going to trim. Whoever was selling at the open, you're back to that. If you haven't trimmed, you certainly would want to be trimming here if you haven't trimmed any because you just rejected the open. Patience pays, guys. Say it. Everyone's getting all giddy. All I do is have a little patience. Found a perfect spot. This trade worked perfectly with the RSI trade, and you got in before everybody else. We watched it live. And what I want to do is just go through some of the pieces. And why I'm going to do this is so that you can do this yourself. If this is of interest, I will do this in greater detail. I'm going to go through it pretty quickly here, but if it's of interest, just comment below and I can clip some of this out, make it into a smaller video, and then I can just post that smaller video, and then I can just add more detail to it. The first thing about trades like this, you're waiting for pullbacks to see if you get them or not, right? And all you're seeing right here is a breakdown off the open, and then when you get that breakdown, you're going back and there's your gap fill. Always mark off your previous close. If you're not marking off your previous close, I don't know what to tell you. but you need to mark off your previous close. Why? Because this tells you exactly where you're at. The next thing is when you have an opening, you always mark off your opening. What we're doing is we're not saying the stock's going to stop. We're not saying the stock's going to rally. What we're saying is let's see what happens and see if we can find a spot that this makes sense to try. That's what we're doing here. Now, as this starts to break down, we're just letting it go, as you heard me say that. And then we find a spot of interest. The spot of interest was right here. And why was this the spot of interest? There's a couple reasons for that. And you can go back on your charts and you can look and you're going to find some spots of interest, right? For me, this was a spot of interest back here. This was a spot, anything like these gaps. But when you look at it, you never really got in there. So these are spots of interest, but you basically went right through it. So when you see that, it becomes a place of interest, but that doesn't mean that that's why you're going to buy there, right? You need to see proof. For me, these are really very simple trades to look at. I'm looking for reversals. In this particular case, this was a very simple reversal. You see how this body completely encompasses that body. This body of that bar completely encompasses that body. This wick and this wick both are down, but this wick came all the way down, encompassing that wick. In other words, you flushed, took those people out that were using that as a stop, and you kept going down. Then you reversed and closed over the entire body. Wicks are price rejection. Has this happened anywhere else in this pattern? No, it has not. So that to me is a clear indication that you might be getting near a bottom. I don't want to tell it that it's bottoming. I want to watch. Sometimes there are these patterns, and these patterns exist, and I am a pattern trader, where you'll pop up and then you're going to just pop right back down, retest, and then go. So you have to be cognizant that that exists. What we're doing is we're not telling it that it's going to work. We're just watching it and seeing that it formed this bar, and then we're getting involved. And then all we're doing is overlaying at the same time, as you saw live. I'm just watching RSI. And if my RSI readings look a little different than yours, that's probably because they are. I just have different indicators set. But we cut under here. I don't really have a divergence. It's actually going pretty perfectly with it, right? So I don't have a divergence, but what I do have is I have a break of the 30, and then I have an overcut of the 30. And I have my bar here. There were a couple other things that were working for us as well. But what I want to do with something like this is I want to understand why I bought it. And you can hear in that video that was live, when you saw that live trade, I'm buying it, and then I'm buying it in another account as well. And the reason for me doing that, multiple time frames. So people will say, oh, he day trades. I've owned NVIDIA now for pretty much, it's going on 18 months. And if you're in the community, you already know this, but that doesn't mean that I'm not going to trade it and pull money out of it every single day because I can. So why wouldn't you do that? It's just silly not to, right? There's just different pockets. We can get into that in another video on how to do that and separate them. But what you want to do is, now that you're breaking out, this is your bar. This is everything. This is what I refer to as a control bar. Now, people will say RSI doesn't work. I would simply suggest that you just don't know how to use it, or perhaps it doesn't work for your style of trading. That doesn't mean it doesn't work. There are very distinct differential statements there. Does it work? If you know what you're doing with it, I think it gives you an edge. Is it for everybody? No. And there are times that if you're trading like zero dated options, RSI is absolutely useless because it's already moved by the time it's happened. So you have to understand the context on when it makes sense to use them. Again, different strokes for different folks. I find it extremely helpful to find places of inflection. I will suggest that this is a great tool for you to utilize now, considering that the skew has changed to the marketplace. And again, we've talked about the skew in previous videos. I'm not going to get into it and exhaust everybody's time again. If you haven't seen that, I'd go back. It was a couple weeks ago on a Saturday. But if you can see in here, it lifts. Now, what are we doing? We're just letting it figure itself out. And then as it trades up, we're scaling out when everybody's cheering and waiting for this to break. We're selling to them. Now, I waited until I saw a little move here, as you saw live, and then it pops over, and into that strength, I'm selling. Into this point, the previous open, I expect people to reevaluate their lives and wonder if they want to stay in that trade or they don't want to stay in that trade. So I'm going to sell into that as well. And you saw that live, and you also saw it in the trading journal. And again, I think it's really important to connect all the dots. And then I just have a runner, and I leave the runner alone. Now you could say, well, why didn't you get out of the runner here, when you saw this divergence? I could have, But I'm trying to leave the runner on for a period of time because it's a stock that I like. And then you just come straight across and I'll show you. All I'm doing is just watching some key levels that you were rejecting in. And then you can just start seeing this left shoulder, head, right shoulder. There's a couple other reasons why I got out of it. But as soon as you started breaking down, that was it. And it was time to kick it. The important thing about this is that what we're trying to do is we're trying to catch the majority of the move. So if you look from 10 to 11 on this trade, meaning the time frame from June 10th to June 11th, I'm not trying to buy here and catch this. We're letting it come down and we're catching the majority of it. So in other words, if you were to map out what we caught, we're in down here and then you're getting out up in this range, okay? And then when you're getting out in this range, what that's doing is it's capturing a lot of the move. Now, did it capture all the move? No, we captured some more here. But if you look at that, and then I sold a piece up here. So did we capture the majority of up here? Yeah, we captured the majority of this move. And that's what you're trying to do. The easiest way to see if your system is working, this is a really quick tip for everybody. You want to see if your system is working as far as day trading, take the average daily move of your chart, and I'll show you exactly what I mean by this. I'll do it here. So if you look at the 10th, you would say that this is the low clearly, and that this is the high clearly, right? What you want to do is you want to take the entire move of the day, and we'll capture it from here over, and you want to look at it and go, this was the entire day. How much of that did I capture? Okay, and if you're buying here and you're selling here versus buying here, right, and scaling out here, then you didn't do your job. You made money, but look at the amount of risk that you had to hold into the trade. So this is a real quick envelope way to look at, hey, am I maximizing the amount of return that I could be getting on my day trade for a day? I hope this was helpful. As always, your comments are appreciated. It helps me create content. Let's take a look at some ideas for the week and get prepped. Now, before we jump into a couple ideas here that I think are really pertinent for us to get, this is the skew that I was just referring to, instead of people going back and trying to find that video. And I just want to explain what it is. It just shows the level of volatility. So what we have is we have volatility here. And what this is just showing the S&P 3-month skew. And then they're just doing a little bit of devising to figure out and come up with a reason to explain what's happening. But essentially what we're seeing, and what you used to see a lot of, is even when the Fed was involved, even when they started intervening back down here in 2008, what you saw a lot of was if you were in tech, you expected this. You expected them to rally, and then you expected them to drop, and then you expected them to rally again. And it was just, you were used to the fact that these things are going to move $10, $20 for no reason whatsoever. And so people would come out and say, well, I don't want to buy those because I don't want the volatility. And that's why you would buy the Procter & Gamble's of the world, and they might do that for a little bit, or you'd buy Coca-Cola. But what we've seen in the past, and what people got used to because of the pandemic and the amount of money that came into the market, where the Fed was literally buying assets, then you got to a point where everybody just thought, well, why wouldn't I just buy tech? It just goes up. And now they're seeing these huge moves of 40, 50 points in like SMCI or NVDA with huge swings and thinking, oh, that means we're going to crash. No, it just means the skew has changed. Now, just a real quick refresher. If you look at this chart and we just look at the basic levels of it before we go further into some ideas here, this is where we're currently at. And if you just draw that line straight across, it takes you to the really low end of the skew, which means the low end of real normal volatility in the S&P. You're at a level that you really haven't been at for literally 20, 25 years. And so this is a really important concept that people are not getting. They're not understanding the volatility. You need to get your handle on this because this is the new norm. This is the way that it's always been. And if you look at the market as a whole, even when you were up in this range, just take a look if we do that 1.5 coming straight across, and you realize how far off you are from that. Expect something like this. And the easiest way to equate it, I was going to ask if you want me to. The easiest way to equate this is to think, expect 20 to 30, maybe even 40% more volatility than you've had on normal if you were just to take the mean line. And you get that, right? I mean, you see where you were during the pandemic, and this is not where you're going. But I think it's very realistic what Nomura is saying here, and that's who did this piece about a month ago, was you're heading into this area. And the reason you're heading into this area is this is QE. The Fed is incentivizing long assets, steep skew to hedge long exposure. In other words, the skew changes because people buy puts to hedge their puts. When the Fed's tightening, Fed needs negative wealth effect to fight demand side inflation. Hikes in QT mean under-owned assets. High cash doesn't require massive hedging. You don't have to hedge in here. There's no need to, right? That's why puts have been so cheap, and they're not getting cheap anymore. So with the new, easier policy about to begin, globally, which could mean return to a steeper skew regime. And I agree with this. This is where you're going, and this is why you're seeing the volatility. Just thought we'd do a quick refresher. Now, as far as names on my radar, I think it's best for me just to kind of give you a top 5 or 6 on the week. There are a litany of names out there that I am looking at. I'm going to just tell you, I'm still looking at this. We're still adding to this. We're still trading this over and over again in NVIDIA. You have to understand something. The 3-year average is a 35 PE. They're going to do at least 40 next year. If you times 35 by 40, it pretty much tells you everything you need to know. For this to even be valued at where it normally is, on average, you're at about 140. And in this kind of market, the fact that this doesn't even trade with a premium to me is just absolutely ridiculous. And I've been saying this for some time, as people keep saying it's overvalued, and they just really don't understand what's happening. But this is on the radar, and it's going to continue to be on the radar. And I think even if you look at what happened, if you watch Thursday's video, and again, you'll note that all these are linked, you have a dragonfly at the top of the chart, which means everybody under here didn't buy. And then, someone actually sent me an email and thanked me because I actually said to them, how long are you just going to wait? How many times are you going to tell me that it's too high, right? I mean, this was earnings, and everybody's like, oh, I missed it. And then you watch the earnings move from there, and you're only up 27%. I mean, I don't know, where does the company go that's going to completely dominate the AI chip market with virtually no competition? And please don't put in the comments AMD, please don't do that. So you see where I'm going with this? There's no way that this doesn't keep pushing. The only thing that's going to change it is a macro event or lack of demand. We've been playing this and we've been talking about it. I have a position in it since back here. Done literally nothing with it. This goes back to multiple accounts, and I've talked about that. We can get into that in another video. But I think this is a really important concept. This over a little bit. Again, I'm not going to have time to edit all this. So if you take a look at this, that's got to be on your radar. If it's not, I think you're a little off in your thought process. This IGV, I want to talk about this. So we really need IGV to move forward. And IGV is expanded tech and software. And we're going to just pop the simplest of averages in before I show you a couple names that fit really what I think what IGV is. And you're seeing this. We're back above where we need to be. We're back above that 55, and we've been there for 3 days, and nobody's really talking about this. So for me, I think it's pretty important, and I just want to spend a moment on it so that you can do your own due diligence and kind of figure it out from there. But you have this kind of DTL here. We start making those higher highs. I think this could continue to push. Now, these kinds of names to me got really beaten down and got a bad rap. And then AVGO came out and saved the day. And if you're not looking at AVGO and the 10-for-1 split, I think you're making a huge mistake. I would continue to look at this. Should clean those levels off and reset them. But the 10-for-1 split, they knocked the cover off the ball and they showed margins are there. Remember that IGV trade that I just showed you, you have names like Dell that are in that. They're in that sector. And look at how we're holding the 55. I use a 12, a 22, and a 55. You should use what you're comfortable with. But that tells you where you're going. And then you saw the same thing happen with some of these other names, like, let's clean off my 1,000 levels. You saw the same thing happen with like SMCI. Now, you never know, but you'd start to form a doji here, and now you're wedged between the 55 and the 22, and you look like you're going to go. Maybe you do, maybe you don't. But I think you're remiss if you're not looking at charts like this. I think you're making a huge mistake and thinking that they're just, quote, done. What happens in bull markets like this is we rotate, and you're going to constantly rotate, and people are going to think that it's over, but it's not. And again, if you look at this control bar, this bar has been in control the entire time. These are names that are going to get very active again that I would not sleep on. Now, if we look at XLC, we can see that this has been jumping and moving around. I actually went on a tangent about this, and I actually probably called the top, where I kept saying, I think it was up like 7 weeks in a row. It just kept pushing. But you're seeing rotation out of those names, and you're starting to see buyers, right? So now we're flipping the control bars on Meta, and there are a lot of these names that are starting to really shape up. Like, take a look at Netflix, for example, and look at how this acted. This is something we actually traded on Friday in the room and did exceptionally well with it. But you look at that break, and you're like, oh yeah, that's really nice. And then you drop it into the weekly, and you put it in context of the weekly move. It's significantly better, in my opinion, for a whole litany of reasons. You're at your third all-time highest close on a weekly bar, but when you dive into that level, and again, I always look at these control bars, and I wouldn't, when people say, what do you mean when you say you would sleep on this? I would pay attention to it, right? You have 2 dojis up here. Dojis are signs of uncertainty, and then you flip. This is the kind of stuff that you want to pay attention to. Also, you want to look for names right now that are not in a position that have anything to do really with interest rates, things that are growing globally. Is this the spot that you need to own Costco? Yeah, that's a question only you can ask yourself. We saw a position back here when we flipped the 55, waited for it to get above a control bar and bought it. And we've literally done nothing with it ever since. I think we're up 70 points in it right now. That space is hot. And I'm not sure why it's so hot, but it is. Even names like BJ's you want to pay attention to and how they're acting. The other space that you really want to pay attention to that we've been trading a lot, the retail space. For whatever reason, these names, some of them are really setting up here, like the Ralph Lauren, the A&F. Look at this ELF. Everybody's waiting for these to drop. Now, there are other issues that we have out there. We have the blackout period that's coming up, and we also have the issue that's going on in France that is becoming an issue, and that can become destabilizing. And we'll cover that during the week in future videos. I'll cover it Monday or Tuesday. We'll get into it. That's it.